Are you concerned about inflation picking up in a meaningful way? I mean, we have heard quite a bit of commentary now that the expectation is we could see something, a temporary jump, but that over a sustained period of time, not so much. How are you thinking about it?
Well, I think we will see a temporary jump, at least in year-over-year inflation. I think the underlying inflation we'll have to see, but I am worried that over a longer period of time, say over the next 2 years, this year and next year, we might see a pretty significant increase in inflation, particularly if the economy stays healthy in the sense of continuing its recovery. So I think there is some concern out there because this monetary policy has been very different in this crisis than it was in the financial crisis. So
do you think that the Federal Reserve might then need to step in more quickly than expected right now? And if so, what would that look like? Or will we be talking about yield curve control, something else?
No, I don't. Hopefully they don't talk anymore about yield curve control. Okay. It seems that Powell is reluctant to do that, and I think he's correct that distorting the yield curve even more rather than letting markets work would not be helpful and potentially dangerous because getting out of yield curve control is proving very difficult, and its benefits, I think, would be minimal at this point. So I think that the real question for the Fed is that it's told us that it will keep interest rates at zero until their full inclusive employment or full maximum inclusive employment is reached. What they haven't told us is what they will do if inflation rises and they haven't reached their notion of maximum inclusive employment. We don't know what they do, and they refuse to say. So that's what the market's really trying to figure out, and they haven't answered that because their forward guidance doesn't afford them or tell us anything about what they would do in that case.
Yeah, well, you mentioned, Charles, how different monetary policy has been during this last year at this point versus the financial crisis. Do you expect that to continue? Is different now the norm?
Well, it's been different in particular in a particular way that I'll emphasize, and that is that during the financial crisis, the Fed did lots of QE for 6 or 8 years, kept interest rates at zero, but things like the money supply didn't explode. M2 didn't grow very fast. In this episode, with nearly $3 trillion almost of
government spending,
reserves and other things fed into the system, what we have is a world where M2 growth has exploded. So that repercussions may be quite different than they were in 2008 and 2009. I think the Fed should be cautious about that and anticipate that maybe things won't go quite like they did in 2008 and 2009 and the subsequent years.
Shepard Smith here. Thanks for watching CNBC on YouTube.